And to help us make it happen, obviously institutional infrastructure is crucial. So we'll have an amazing, fantastic panel discussion led by our dear moderator, Ian Simpson. Ian, I will give you the floor, and please feel free to introduce your panelists.
Good morning, everybody. My name is Ian Simpson, Director of Communications and we have a great panel coming up, very interesting participants. So let's bring them out, have a seat, and we'll get things started. Have a seat, bring your coffee, bring whatever, water, yes? Oh, there you go. Good, yeah. Coinbase is taking care of us. Okay. Good. Everybody feeling comfortable? Good, settled in? Great. So the topic is powering the next wave of digital asset institutional adoption. I'm going to give time for our panelists to quickly introduce themselves. First of all, Victor Busson, CMO of Taurus. What is Taurus doing?
So we are a tech firm that provides infrastructure solution to both financial institutions and non-financial institutions. So infrastructure, it means custody and tokenization. So basically with our tech, those players will be able to manage both cryptocurrencies, tokenized securities or assets, and digital currencies.
Good. Eva Lawrence at EMEA at Figment.
Yes, that's right.
What is Figment?
Figment are the leading institutional staking provider. So we help institutions from crypto hedge funds, asset managers, all the way through to banks, trading platforms to enable and launch staking strategies. So it's a proof of stake tokens via non-custodial protocol staking.
Super. Frank von Zegveld from Talos.
Correct.
Talos, excuse me. Yeah.
No
what
worries.
is Talos?
It's a mismatch. Good morning, everyone. Frank von Zegveld. I'm running sales in EMEA for Talos. We're an institutional technology company providing the full trade lifecycle in the digital asset space with one single entry. And I'm looking forward to this discussion today.
Super. And Ambre, CEO of Kaiko. Kaiko is
a market data provider in the crypto space.
Yep.
We work with financial institutions, regulators, and large crypto corporates with anything that has to do with financial data, which is stuff like prices of crypto assets.
Mm-hmm. So data is the new oil. Okay, we'll come back to that. And finally, Guillaume Chatain from a company I think we've heard of, Coinbase. What are you working on, or what is Coinbase working on right now?
Coinbase is primarily seen as being an exchange, but we're actually much bigger than that. We see ourselves as being a bridge, studied as a bridge from fiat into crypto. And today we have evolved into what we're seeing as a bridge to bring 1 billion users into Web3 and on-chain. On the institutional side, our flagship product is called Coinbase Prime, and it consists of 3 important parts. One is custody, the second is trading with multi-venue executions, and the third part is prime services, which are financing, staking, and so on.
Good, super. So we have a great lineup today. Just to tell everybody in the audience and also online, we're going to take a quick look at the current state of institutional adoption. We're going to look at a few barriers and problems in the space, and then how all of our panelists are potentially addressing these barriers, and then take a look towards the future. And just to warn you, there will be a reference to AI somewhere in the panel. Watch out and see if you can catch it. So to set the stage for the first question, right? There's a financial institution which I think most of us have heard of at some point, somewhere, Goldman Sachs, which said in 2021 that, among other things, due to the scarcity of regulated exchanges requiring rigorous and verifiable reporting standards, they would not recommend their clients to invest in crypto assets. Then, in 2022, they started doing Bitcoin-backed lending for their clients, and then recently, some time ago, announced that they would be perhaps deploying millions to acquire crypto companies. Kind of hot and cold, if you think of it from the institutional players like Goldman Sachs. So the big question is, where are we actually in this whole space? And I start with Frank. What do you actually think in the space?
I think institutional adoption as general, it's still in an early stage, but it has arrived. And that's what we see across the globe. And you see a bit of a not mismatch, but more like a difference between the various regions, if it's the US, if it's EMEA, or if it's APAC. But you definitely see that there is a demand and a growing demand specifically coming from EMEA region at the moment. And even an announcement yesterday with regulation in Hong Kong, in APAC, you now see that more institutions are gearing up to be part of this industry. So from our side and the interest what we see in the market, definitely an uptick coming.
Okay. And Taurus, do you feel it's at a tipping point? Or what do you see?
So the way we look at it is less from an investor, it's more from an infrastructure point of view. So what does it mean? Is that we give the tech so that after clients can offer financial products built a bit for digital assets. And the way we look at it is more from a depth point of view of adoption. So it's not are they in or are they not, it's more where are they in their journey. So usually, 3 to 4 years ago, it was all about crypto, okay? Offering custody of cryptocurrencies, so after clients could actually purchase them. Now, it's a bit different because the acceleration is more on asset tokenization. So what does it mean? It's all about digitizing private assets and changing the infrastructure. So the demand and the requirement is kind of different. And then where it's going, probably, and I will comment more later on this, is more on CBDC stablecoin also. So it's like first was the cryptocurrency recognition as an asset class. Okay. Now new use case appearing a bit more complicated, touching more the securities world. Okay, so the finance world, and then probably it will be more tokenized cash, but with a legal tender. That's how we see it.
Okay, we'll come back to that, of course, as you mentioned. Eva, from your standpoint, Figment, what are you seeing?
So I think that at the moment, the infrastructure piece is the most important. So companies, that are building around the infrastructure piece are where the institutions are looking at. They're going, okay, how do I enable my business to support crypto assets from whichever aspect you're looking at? If you're looking at investing, if you're looking at custody, they're all thinking about how do I integrate my existing setup with new digital asset setup. And so I think that we do in the crypto space like to get excited about any hint of institutional adoption. Even the smallest things seem to make large headlines, but I think we're still in that building phase for institutional adoption. Yes, we have definitely seen institutional adoption, but what the focus is still has been how do we have the building blocks in place that when we are able to move forward, or as we slowly move forward with launching products, we have the back end set up, we have collateral risk management set up, reporting, tax, etc. That
all
enables
those
us
topics,
exactly.
Yeah.
It enables us to support those products.
Okay.
So I think it's very much the infrastructure and building phase.
And so one other, sorry to say, boring topic, data. No, I shouldn't say it like that. But what do you think, Ambre? I mean, people have said for several years, the last bull run, 2021, institutions are coming. What does the data say?
So before going into the boring part of that answer, I come from TradFi, and I've done equity derivatives for about a decade before getting into blockchain. And I think, to your point, Victor, I completely agree. I think there's a difference between the perception that institutions have of crypto today versus what it was a couple of years ago. Before, there was this sentence that I hate, which was, blockchain good, crypto bad. But it was very dumb because they were trying to rip off crypto from crypto. Like it was about crypto a couple of years ago, but they were still trying to figure out a way to say, yeah, we're an institution, we think crypto is good, but we don't really like crypto, so blockchain is good, crypto is bad. And I think this was a little bit short-sighted, and this was not fully understanding that a blockchain without a form of payment, which is the crypto, to remunerate a network to maintain the database, would not be a blockchain. And I think there was this misunderstanding from institutions, I would say 5 years ago or 7 years ago. Today, indeed, we are going a little bit back to crypto bad, blockchain good, but in a very different way. I think they've understood what crypto was, but because of the regulatory environment that is not really in favor of institutions really moving into crypto, institutions are going a little bit of a kind of a step forward, thinking about what I believe to be the future for them, which is tokenized assets, using blockchain for triggering operational efficiencies in the way the capital markets industry function. I talk about the capital market industry because that's my DNA, but the reality is industrial applications across all industries that relies upon the execution of contracts. Finance is obviously a very obvious suspect. And I think that people have understood now, institutions have understood now that crypto is not a threat. I personally, and that's a personal statement, but I personally don't believe in a fully decentralized world. I think we will need exchanges, we will need custodians, we will need market infrastructure providers to bridge kind of the world of crypto and the world of finance and other industries. But that where the big opportunity lies for institutions and industries is in the execution of contract and the operational efficiencies that brings, which means if we take the financial industry, we will still need a front office, we will still need a bank, we need people to structure contracts between parties. What we can disintermediate using blockchain is middle office, back office, and settlement, right? I mean, 90% of financial flows in the institutional world today are cash settled. What we really need from blockchain is the calculation, the computation, and then the kind of delivery of flows. We don't necessarily, I think, need a fully decentralized, a little bit utopian future where we disintermediate banks. And I think banks have now, and financial institutions, understood that. And everything we hear about asset tokenization, real-world asset tokenization, CBDCs, et cetera, is about that. So I think we really made a step of giant in the institutional adoption, but it's just not the same adoption that we thought it may be 5 years ago.
So you would say people are beginning to understand the connection between blockchain and the incentives behind blockchain,
yes,
which leads to cryptocurrencies and the native token of the blockchains. Yeah. So that brings me now to the topic of adoption. Now, a majority of the people on the panel here, also from my side, we think of it more from the investment side. Adoption being how many people are more investing into these assets and putting them in a portfolio and so on and so forth. But there is a crossover between that and the blockchain use cases. And Coinbase brings out Base, the layer 2 setup. How is Coinbase thinking about that? And what is your big picture view, Guillaume?
Well, first, in terms of adoption, I think Tina from Circle said it very well when she said FTX puts us back a few years behind. Definitely slow down the adoption that we're seeing on the institutional side. From my vantage point, I can share a few stats. Well, first, we have the largest asset manager on the planet, BlackRock, who has signed an agreement with us, so we have this partnership. Larry Fink doesn't go into blockchain and crypto just because he has decided to do that independently. They've been surveying their clients, they're receiving requests from clients, and that's the reason why they're entering into the crypto space. In terms of other institutional investors that, and I'm speaking mostly as well from an investment point of view, hedge funds is the bread and butter of what I'm doing at the moment. I would say 25% of the top 100 hedge funds are already connected on our platform. On the largest hedge funds like global macro, multi-strat funds, 50% of the top 25 are also connected or on the verge of being connected. There's not a lot of flow. I would say right now there's not a big rush of buying Bitcoin, but people want to be prepared for the next bull cycle. People are waiting for more liquidity in order to deploy their capital. When you speak with hedge funds, they're going to tell you, I need two things to deploy my capital, and the strategies that I'm working with on the traditional finance side. One is I want liquidity, and they want the liquidity coming from retail. The second one is volatility. So we have volatility in crypto markets, but right now we're still waiting for the liquidity from retail. It will come back. There are other topics that we're working with clients, which is corporates. I would say we have like roughly 100 big corporates that are connected to the platform. And of these, 10% are probably part of the Fortune 500. 90% of these are doing this to access Web3 or for their Web3 initiatives. The remaining is probably for USDC or stablecoin purpose, being able to transfer value from one place to another very, very, very easily. We're also working very closely with big banks. I would say we have a couple of tier 1 banks that are already connected on the platform, and we keep receiving RFIs. Like we have, like I would say at this point in time, probably like 20 RFIs from very large banks that we're responding to.
So there is interest. It's growing. It's coming. It's developing slowly. Still, yeah. And you hear crypto not blockchain, or blockchain not crypto, or
it's
people are agnostic on this.
I'm not an agnostic. I see like the big banks, and like if you look at JP Morgan, Jamie Dimon is always like bashing on crypto.
Yeah.
But they're very strong about blockchain, and what they're doing is they're building like massive infrastructure on the blockchain side, tokenizing money market funds together with BlackRock, using their JP Morgan coin. So it's not really crypto; it's their own coin for settlement and repo purpose. So it's really like at this point in time, really blockchain and not crypto.
Okay, let's drill down now just a little bit before we move on to talk about some of the problems or barriers and things that are still out there, but. Institutional adoption, what does it mean? What are the institutions? So, you've got banks, securities firms, you mentioned hedge funds, asset managers, family offices. There's a whole array of institutions, so to say, corporates then who are using blockchain and various things. We had two things come up in the news recently, right? Deutsche Telekom is going to use Polygon for some things. And what was it? PayPal Ventures is investing in Magic. So there's a lot of things on different levels. But Frank, like at Talos, how do you offer, or what do you see from different levels of institutions? Is there a different need?
Yeah, there is. There definitely is. I think there's also institutional adoption means different to different players in the market. I mean, when you talk to hedge funds, it's all about trading.
Yeah.
If you talk
and
about
speed, is speed a topic?
No, it's not so much on. You mean the speed on the technology side of things, or more
trading
on the adoption
speed
itself?
Yeah.
No, it's more like in general. I mean, they have an interest to be part of this game and be part of this industry and this ecosystem from a trading perspective. Where you speak to pension funds, it's about investing and being part, let's say, on securing their market share in this exciting space. And when you talk to banks, it's more like facilitating a marketplace and provide, let's say, payment services or custody services, and just be that more towards their client franchise. So it's more from different segments of the institutional players out there with a different interest on participating in this game. Okay, and Eva, Figment has on their website a very clear focus towards asset managers with staking. Yep. What is the feeling from that sub-segment?
So, I mean, for me, when I talk about institutional adoption, I'm not really talking about asset managers, except for the large asset managers. To me, institutional adoption is about the banks and the multinational asset managers, money managers coming into the space. As Guillaume was saying earlier, the hedge fund types, smaller crypto VCs, small asset managers, they are very much already in the space, right? They're able to move quickly. They're able to, get approval. They don't have as much red tape. So from a staking perspective, those smaller firms are able to launch staking strategies quite easily. But the real institutional adoption, when we use that phrase, to me, what we're talking about there is your tier 1 banks, your global asset managers, maybe your large pension funds, those institutions that have so many moving parts internally that they have to navigate to get sign off on, the tiniest of things. So I think, when we
bureaucracy, yeah.
Exactly. So when we see more movement from those entities, I think that's the piece that makes people sit up and take notice, rather than say, a small fund increasing their position in ETH, or looking at offering additional cryptocurrencies.
Okay, and there's an interest in staking. I mean, staking as a one of the more interesting crossovers between the blockchain technology and usage and the potential investment return aspect.
Yeah, I mean, there's interest in staking from every type of institution to that small VC or asset manager all the way up to tier one banks. Because for everyone who holds or is thinking about holding an asset like Ethereum, it's quite an easy concept to understand that if I'm holding this asset, do I not want to look to receive some type of return? Do I not want to try and hedge against the volatility of the asset price? So I think that as a concept is something that all institutions can grasp. It's about the speed at which they can deploy solutions or offer solutions around staking based on their size.
Okay. Now we talk about holding things. We come to custody, big banks. Taurus is focused on this segment of institutions.
So
are they fast? Are they doing it? How?
No, so I think what needs to be taken into account is really first, it depends on the geography. Okay, I'm going to get into more details. And geography because of regulatory reasons.
Yes.
And second, it depends on the typology of clients.
Yeah.
And third, it will depend on probably the type of asset class, which is linked actually to the typology of clients. So if being more specific, recently, you have the Central Bank of Brazil that released their framework for CBDCs, which is a sandbox on Hyperledger Besu, where they shortlisted basically a set of financial or set of banks and tech providers that will actually enable and do testing for stablecoin and for the new, basically, digital real, which is a local currency. So we have a bit of regulatory framework. Now, if you look at Switzerland, so basically, it will be different. So here in Switzerland, the big advantage, and we will come back to it later, but you have a clear set of regulation. So you have what you call ledger-based security that is recognized. And the catalyst for that, so it was back in February 2021 with the Swiss DLT law. And the consequence of that is that it opened the door to tokenization of equity, debt, structured products, funds, and then basically you can go beyond to more and more assets. And the beauty of it is that we saw investment banks starting to tokenize even or private banks, corporate banks, tokenizing those structured products. And we did it, for instance, with concrete example, it was with Pictet, Credit Suisse, Vontobel. And another good example is Credit Suisse, actually back in 2021, end of 2021, they actually integrated our tech, and they tokenized a SME. So a mid-cap company, a high-growth company, on their core banking system. So basically, and then what's interesting is that it goes back to the point, blockchain, not crypto, because the compliance team, it's public, so I can share this information, was saying they cannot
Don't give away any secrets.
No, voilà, they cannot book cryptocurrencies on their balance sheet. Okay. So. But they want to do asset tokenization, because asset tokenization is about digitizing the value chain. And basically, they tokenize the asset using like what you call a gas station, where they deploy a smart contract, they pay for gas fees without having the Credit Suisse entity, but actually having like a fee payer externally. So basically, like at the end of the month, they send us like a utility bill to us, where we will actually be doing the invoicing. But it goes back to this point. The depth of adoption will only depend on the regulatory framework. In Germany, you have the EWPG, Electronic Securities Act, where the only framework to be able to tokenize is actually bearer bonds. So each time you have a regulatory improvement, you will be able to have more depth of adoption. And then cryptocurrency will only follow in EU once MiCA will be clarified. And for sure, for instance, even some other central banks, or big banks are just waiting for this regulatory clarity to offer those new products, whether custody of crypto, custody of digital currencies, and etc.
Yeah. Interesting. There's one segment of the institutional space not many people mention. This is pension funds. Big space, lots of money there. But what is it? The Ontario Teachers Pension Fund got a bit burnt in FTX. So is that off the table now? Anybody have any views on that segment?
Asset allocators are not like big fans of crypto at this point in time, I would say.
Yeah.
As I said,
but the
there's no
counter
rush to buy
argument would
BTC.
be.
Sorry?
The counter argument would be, I mean, how would you convince them?
Today, the discussions are not about like investing directly into crypto. It's more about, hey, here are the funds where you can use like some active managers to invest in crypto. Part of our role at Coinbase, because we're like really in the middle of the ecosystem, we see all these hedge funds being connected to us, and we're doing some cap intro with these asset allocators. Not a huge demand right now, but it's a lot of education and putting the right managers in front of these allocators.
And Ambre, would you say the data supports that?
I agree with everything that's being said. I think we can split institutions, financial institutions, into regulated versus unregulated. Clearly, to what Guillaume said, and we see that a lot on the unregulated side of relatively large financial investors, they're all into crypto. I mean, they need volatile assets. Indeed, we lack liquidity, and we know that this is a problem. In all honesty, like, apart from Bitcoin and ETH, there's not much liquidity right now. Kaiko, one of our business units, it's called Kaiko Indices. It's a regulated entity where we do data products for financial products. And out of the world of, I think, 10,000 plus crypto assets that exist and that have some liquidity, if you consider and put some threshold on minimum liquidity, assets that can be traded on reputable exchanges, and assets that can be stored at reputable custody solutions, you end up with less than 50 assets. And honestly, out of those 50, probably 5 are actually decently liquid and 2 are really liquid enough. So we still lack liquidity, we have volatility. All of the unregulated financial institutions are already doing crypto because they know how to deal with risk and they know how to deal with liquidity risk, market risk, etc. Where I think what Eva was saying is, I think the big question here is tier 1 banks is, when are they actually going to get in? And that is highly dependent on regulation. What we see, so in our client base, we have about 200 clients at Kaiko. It's only institutions and corporates. And 30% of that are hedge funds and active investors. That's why they need data. I mean, it also makes sense, right? What we do is historical data, real-time data. So if you're an active investor, you need to have this visibility on your risk management and trading capabilities. So we don't do execution, by the way, but we do the real-time data that triggers the investment decision. So we do see that already being there. Pension funds, we don't either.
Very conservative, very risk-averse, yeah.
And also buy and hold type strategies, I would say. So, not in need of real-time data. So I don't think...
Don't they understand the long-term Bitcoin? I mean, the charts are there. You guys make great charts.
I wonder if they're not a bit like regulated institutions, as in, they cannot afford to take bets on volatile asset classes. And even though they kind of do, without, they're like, I don't think they can do it consciously. Crypto has a perception of being a volatile asset. They end up, investing in, we know mortgages and real estate and stuff like that can be 10 times worse long term. But on the other hand, the perception is different. Exactly. And then on the speed of execution, I mean, we're all set up from an infra standpoint to support lower latency type activity. It doesn't really exist today in the space. I mean, you don't have high frequency trading as in the TradFi type high frequency trading. It's still relatively,
why is that? Why is there not that going on yet?
I think one of the reasons, and Guillaume can probably have an opinion, is just the infrastructure and the state of also the trading infrastructure. Even though it has significantly matured, most exchanges still run on the cloud, on AWS. And there's no, in order to have a low latency game, you have to come in and plug cables in a a physical data center. And there's this notion of, almost distance, so you can shorten the length of the cables. We're not there yet in crypto. And I don't know if there's a very, very short-term target for exchanges to get into that game. I feel for that we need to have liquidity. Still a few things need to happen. So low latency play, high frequency trading is not yet a thing in crypto. And in my opinion, it's not a bad thing because we don't necessarily need that right now.
Yeah, let's come now to maybe 3 barriers, right, and talk about that. And let's start with that one, liquidity. Coming back straight to you, but then going around the room. And some of Kaiko's data has shown that, right? Liquidity has dropped significantly. liquidity is right now a bit more in derivatives than spot, right?
Yeah.
How much of that is a barrier to institutions?
I mean, liquidity is not to execution, but liquidity is a barrier to everything, right? It is a barrier to people building also passive investment strategies on top of crypto. A lot of the regulated financial institutions, the only thing they can do is regulated ways to invest with a synthetic exposure to crypto, and that's CME derivatives mostly, right? So that limits what you can do. So clearly, liquidity is a problem. One thing interesting that we see in the data is that the volume, not just daily traded volume, as in executed transactions, but also market depth, as in how much volume is currently sitting on exchanges, on the order books of exchanges, on the buy side and sell side, has also reduced significantly. And I don't think that's necessarily a sign that people are less willing to trade or less interested. I see that as a consequence, a direct consequence of FTX, as in people don't like leaving as much funds on exchanges, and they would probably bring in, transfer the funds when they're ready to actually make. Whereas before, what we saw was much more, and again, I'm talking under, please correct me if I'm wrong, but I am feeling that people are more moving to different type custody solution versus leaving too much of their funds on exchanges. And for me, that's just a direct consequence of FTX about where do you store your coins while they're not being actively traded.
Yeah.
And that's not necessarily a negative, as in it doesn't mean that people are less willing or interested to trade.
That's a really interesting point when it comes to liquidity. So, I mean, Guillaume, correct me if I'm wrong, but mostly when you trade on FTX, you pre-fund, right? Or, excuse me, not FTX, Coinbase. Sorry. Oh, sorry.
Oh, I hate it when that happens.
No, that was not intended. But it's basically the same everywhere, right? You send in, then you trade, or you get a line of credit or something like that. So is that a liquidity barrier? I mean, institutions are not necessarily used to trading that way.
Yeah, you typically have to pre-fund all your trades. With big institutions, we give them lines of credit, so they can just trade in and out all day, and there's a net settlement at the end of the day. To your point, just coming back before to HFTs, totally agree. We don't have that in crypto, where it's all about low latency in traditional finance. We don't have this in crypto, but we still have a lot of market makers that are very active. They just behave slightly differently, and it's not about being just next to the server. We don't offer colocation. People know more or less where our servers are, because on AWS, and you can see the volumes and what is going on. So people are trying to just get close to it, but they cannot just collocate there. At this point in time,
do you think that will come? I mean, colocation, high speed.
I don't see it coming. We could ask, we have someone from IMC just smiling. But I don't see it coming. Actually, not with us at least.
Okay.
In terms of liquidity today, you still see some liquidity in the market, but there's a lot of market makers trading against each other. So it's a bit toxic. Some of the big funds that we're seeing having large positions are telling me, I'm a bit scared right now, especially entering into the summer. If I have a big position that I need to cut, I don't know how much is going to impact the market.
Okay, let's jump to one other barrier that we talked about, integration, right? So financial institutions have their systems, some of them very old, if you're talking Credit Suisse or whoever, ancient, right? Talos is trying to integrate across various exchanges and various things. How do you address that kind of?
I think one of the barriers right now is still the lack of tooling what people are familiar with in the TradFi space. Like if it comes to portfolio or risk management tooling, or let's say have an holistic view on what's happening in the market and be able to aggress and act on it. And I think that's a role we try to play in this market to facilitate that kind of tooling and level of support to optimize that kind of service. So I think when we speak to institutions, it's all about risk, see what's, let's say, in the portfolio, how they automatically can rebalance, have full visibility what's happening in the market with the help of data providers, with the help of custodian service providers, with the help of transparency, what's, let's say, in their wallets, and from that perspective. And I think that's a level where people are asking a lot of questions about. Even today, when you take a look on RFIs or RFPs, risk, and not so much risk itself, but risk management and tooling around that is taking a big portion of conversation, especially after FTX or what's happened in the market. That's what we see on the technology side of things.
And your development at Talos, is this like based on crypto technology and focused on working with crypto, or is it trying to give institutions what they want?
It's a combination of both, and maybe some people saw it in the news. We recently acquired a company called D3X, a portfolio engineering and optimization tool, familiar for people who are trading on the TradFi on equity and fixed income, which we then, let's say, converted to make it in the same level of institutional rebalancing of your portfolio for the digital asset community. So I think with speaking and also being proactive on finding solutions which suits this industry as well, and tailor, let's say, customized solutions for clients who need a different way of managing their risk, that's where we definitely play a role in, and be proactive on that side.
And Taurus, what challenges do you face, or how are you addressing the challenges of actual integration in systems, core banking systems?
Absolutely. So the main challenge
beast, right?
So even those big banks have not only one core banking system, but they could have several.
Yeah.
So ultimately, you have different layers. But first layer is you think about the deployment model that will be chosen. Usually, the deployment model will depend on the regulatory framework. So if you have a regulator imposing on-premise setup. On-premise is basically a local setup within the server of the bank by itself. You need specific setup, so you need to deploy the full infrastructure behind the firewall of the bank, basically. Then you have more straightforward managed services, like cloud-based deployment. Third type of deployment would be kind of hybrid. Sometimes you have some data requirement that needs to be on-prem, then the nodes can be done as managed services. First layer. Then you have the integration with core banking system, the reconciliation with the core banking system, so like Temenos, Avaloq, whatever it is.
And how easy is that today?
So today it's done. So for us, we have API. Then the next level would be what you call direct connectors, what you call STP integration, straight through processing. So that it's still more seamless, fast to deploy. But to give you an example, it could be as fast as 10 days deployment for managed services. Then if it's on-prem or something more sophisticated, where you need to build a middleware between, the order management system. Yes, the core banking system, the connectivity to exchanges. So you have different layers that will appear, can take 2 months, 3 months, something like this, if it's kind of big. Then what's also quite interesting is we also need to connect basically the different bits and pieces of the different provider. So you have like staking, obviously, staking providers. You have AML, KYT providers, like the forensics on blockchain. I'm not going to do advertising for any, so I'm not commenting on name. You have pricing feed, obviously, like Kaiko is here. You have counterparties, like exchanges. So you need to plug all of this so that at least from a banking point of view, you can coordinate, you have a view on everything, and then also coordination between all the exchanges, also with Talos. So you have tons of different layers to be taken into account, and this is where the complexity comes in. And after custody provider like us or others, basically the job is really to take everything, to have something really to coordinate, and to give the tools so that the team and as a legacy technical team can really be able to adapt, manage, and
I imagine as you're working with, say, mid-career, mid-managers at tier 1, tier 2 banks, the thought of trying to integrate all of these different levels,
but isn't more the difficulty that some of these systems and infrastructure are from the 1800s, pretty much, so it's not necessarily that people aren't progressive. It's more that the settlements, settlements infrastructure, the back-end ops, all of their individual services and that you have to integrate with are so old. It's like, at what point do you stop repairing the vintage Volvo and go out and buy a Tesla. Like, it's all of these systems and setups that also make it difficult.
No, absolutely. No, everyone is at a different stage. So, for instance, even reconciliation, you can do it via XML file, like CMS, so like an Excel file. It will be manual reconciliation. It can be done also just via usual API, more automated. So everyone, every bank, every player is having its own, basically custom, infrastructure.
And so there's no standard for
there is no everyone has its own setup, and I think it's our job to adapt to the existing setup and make it easy. So but basically, it's impossible thinking that we are going to build something brand new and everything for basically doing tabula rasa or forgetting everything from the past is a bit an ideal that is not realistic today. And actually, if you want to really drive this institutional adoption, you have to adapt as a player and make sure to help them and guide them, bringing all the infrastructure to the next level.
So make sure that you have pattern match of what they expect, what they want, and put it together. Now, there's one big elephant in the room. Sorry, we have to talk about it. Regulation. It is a barrier. Let's just put that out there, right? Without putting anybody on the spot. How is it developing? How are you seeing it? And how and let's talk Switzerland, because we're here in Switzerland, and Victor mentioned that as well. How good is Switzerland in that regard? Maybe Ambre.
I'm happy to give a data-centric answer on the topic of regulation. I'm not an expert in the Swiss regulation, but generally I think there's been, over the past 6-9 months, strong regulatory focus, obviously maybe catalyzed and triggered a little bit by the shenanigans of last year. But we, from a data standpoint, have seen a lot of RFPs being issued by regulators. Proud and happy to say we've won all of them. But that includes the SEC, the CFTC, FDIC, EBA, ESMA. Every kind of major European and American regulator have issued RFPs for data for a couple of purposes. One is research, market supervision. One is kind of law enforcement, understanding flows, doing market surveillance, getting a better grasp at the asset class from a data standpoint. And what they mean from a data standpoint in our context is financial data, which is volume, prices, looking at order books, looking at stuff like market manipulation, market abuse, etc. So that is something that they've focused significantly on over the past 6 months. And data in crypto, it's very fragmented. It goes all the ways from network data for retail on a dashboard to public websites like CoinMarketCap that are great for retail, all the way on the other side of the spectrum to us that are more bringing a capital market style data service to crypto. But regulators have really started, I think, taking seriously the importance of accurate market data in order to monitor markets. And also, it's a narrative I'm pushing a lot, especially when I talk to crypto corporates, such as exchanges and custodians and protocols, importance of market data hygiene. And I'll give a very specific example of what that means. Today in crypto, there's no regulation around where you source your data for any kind of reporting use cases, regulatory use cases, disclosure use cases. And so a company can take whatever lowest price of Bitcoin that is suitable on a given time period to report taxes, but then they can take the highest price of Bitcoin every day to report their NAV, and then they can report a different price if they're a custodian to calculate asset under custody. And it creates a lot of confusion. When you're an institution, let's say you're an asset manager, your fund admin cannot have a different price than your custodian, because we're talking about literally giving a dollar counter value to a certain number of crypto tokens in absolute numbers. And so that kind of data harmonization, setting standards, bringing in TradFi standards when it comes to market data hygiene into crypto. Obviously, I'm super data-centric, but I think it's a very important step in institutional adoption. Unless we start having clarity and standards and visibility, it's not just about the infrastructure, it's about the quality of the data, right? So for me, there's, as far as Kaiko is concerned, this regulatory move towards a more institutional use case, use for data, is a very strong signal that they're taking it seriously and that they will hopefully, if obviously it goes in our direction, hopefully start, if not imposing, at least recommending proper uses of market data in the operational systems of crypto companies and crypto investors. So that's the pure data view.
Yeah. That's interesting. When it comes to regulation and the attitudes of regulators towards staking, are you having some conversations?
Staking is not a regulated activity, but I can talk about regulation in general because it's not something that currently falls under any regulatory regime. But I think what we have when it comes to regulation in crypto is we have this view as an industry, as a collective sometimes, that we are so different. We're really different, we're really special, we're unique. And so we need to be treated as such. And there are some instances where that's true. There are some instances where you can't kind of shove us into a commodities framework or a securities framework. For example, if you're looking at disclosure, who makes certain disclosures, where does the responsibility lie? If that's applicable to crypto assets, well, how does it apply? And we need frameworks to cover instances like that. Maybe as well, if you look at settlement, ownership, if you have a DAO, who is considered, an owner, a person of a significant function for that entity. So there are gaps in the regulation that we are hopefully moving towards with MiCA, but I think there are also areas where we have existing frameworks that as an industry we should be utilizing. So for example, it's very clear from financial regulation you should not be commingling customer assets. Crypto and crypto assets should not be any different from that. In the same way, you shouldn't necessarily be have an exchange and have a fund that's trading on that exchange, a la FTX,
Alameda,
right?
FTX, yes.
There are certain rules and regulations around fraud, misuse of customer assets, misuse of information that are not crypto specific. And I think what we need to do
need to fit in.
is exactly push for regulation, and hopefully we have at least a step towards that here in Europe, but then also show that we are embracing and understanding existing regulation that is non-crypto specific, that is about good market structure, that is about consumer client protection and
market
showing how we're
integrity
enforcing that. Exactly, yes.
When I come back to a point Ambre made, and now coming to Guillaume, like market surveillance and market integrity, is that something that Coinbase has in place to say to certain regulators that nobody is wash trading on Coinbase and things like that, or?
That's something we're taking very seriously, yes. Most of the people that are at Coinbase are coming from traditional finance. So it's the same old issues, dealing with compliance department, having training every week or so, just keeps accumulating in my mailbox. So we're doing exactly the same thing as in traditional finance. There's trade surveillance. We have a list of restricted tokens that we cannot trade on, stuff like that. We're paying very close attention to that. On the regulatory front,
and you're here in Switzerland, so you must love Switzerland and the regulatory framework here, right? Or?
I think it's very, very progressive, and I really like Switzerland for that. I think it's really a tale of two cities at the moment. It's really the US versus the rest of the world. We have very bright patches everywhere else apart from the US, and the US is really the SEC. Even the CFTC and the SEC disagree. Even within the SEC, there are some disagreements on how to
For sure,
to regulate.
Hester Price,
The rest of the world, very positive. MiCA in Europe, I think is putting a framework where there is harmonization within Europe, where there is clarity and a level playing field for all the crypto players. The rest of the world, the UAE is super progressive, and there's going to be a lot of people opening shop over there. In APAC, Singapore was quite restrictive at some point. They're opening and distributing licenses.
Now.
Hong Kong is changing like crazy.
I think as of today, retail clients can trade crypto. Australia is also like quite positive. So everything everywhere is, I think, very positive except in the US.
You were saying, Ambre, that you're looking at Hong Kong.
So we've
very
been
good.
in Singapore. We opened our office in Singapore kind of post-COVID at a point where Hong Kong was really not a friendly place because of a million things, not just crypto. And earlier this year, the HKMA and FCA opened a consultation paper on regulation and market data, to which we replied to on the data side, aligned with what I said just before. And the new regime kicked in yesterday, and it is, in my opinion, going to attract, it's enabling better retail protection, but allowing them to trade crypto. So obviously, it attracts institutions to offer services there. Hopefully it's going to attract a lot of kind of also APAC money, Chinese money. So we're seeing, we relocated our head of APAC to Hong Kong back in March to kind of be here, be on site, have boots on the ground and be ready to work with them. There's a bunch of regulated entities, you have, whatever. You have already some regulated services on the exchange and custody side, but we think it's going to clearly increase and drive growth in the region.
So last question on the regulation side to Frank and to Victor. Tokenized assets, and Taurus has a marketplace and is looking to promote this and do this. And does this fit into what Talos also sees in the future?
So from a regulatory point of view, let's say that we love regulations. We are even the only tech that is kind of regulated. So we have a securities firm license regulated by the FINMA. Okay, the securities firm license is one level below a bank, the banking license. With this license, basically, we operate what we call an OTF, an organized trading facility, which is in the US equivalent of an ATS, an alternative trading system. The full point is really to look to create liquidity for those tokenized securities. Because today, again, tokenized securities are not cryptocurrencies, so you need a specific set of license. Now, regarding pure license, so FINMA did a fantastic job. So I'm really talking on behalf of Switzerland because this is where we are based. How we are so mature on this topic is thanks to the FINMA. Honestly, the framework that they provide already for cryptocurrency back in 2018, then recognizing after ledger-based securities in 2021. So it's leading the way. Then you had EU, actually, which is a bit behind, like I would say 18 months behind, but basically it's catching up. So you have the EU DLT regime pilot that was voted back in March, and now it needs to be translated by local jurisdiction to become effective, and then you will have MiCA. US is again more behind, lagging behind. Everyone knows that, but no one knows if it's... So
the regulation is there. Now, how are you going to utilize it, and how are you going to push it, and how is Talos perhaps also focused on this?
So on our end, the way, so again, you have the infrastructure activity, you have a global reach. Then TDX, which is our exchange, for instance, to be more specific, it's a financial service activity. So basically, we are facing also some cross-border, so we are very cautious because it's important not to, for every country you will get in, you will need basically to comply with local requirements. So strategically, right now, the focus is obviously more Switzerland and Swiss entities. We don't know what the future holds, but basically, on our end, we need a full clarity and implication from the regulatory framework in EU. That will be the next step, probably. That will be how we see it.
And is Talos ready for this, for tokenized securities, DLT securities?
I think eventually a lot of asset class will be on the digital asset rails as a whole, and tokenization is a big part of that. To what extent and in what time frame will be quite interesting to see. There was actually a panel last week on another conference where they say the adoption can be anywhere between 3 to 10 years, and to what extent, and let's say what will be tokenized and how it will be, let's say, distributed throughout the market. But it will happen. And coming back to the regulation, I think even as a tech provider where we're not have to be regulated ourselves till date, we still welcome clear regulation. And what you see now in EMEA and as well in APAC from the team, our sales team there, Hong Kong, Singapore, and wider area around there, we see a lot of interaction with institutions because it's becoming more clear how they can interact with this market, what they need, what they expect, and how they want to be involved. So I think you see it here in EMEA, you see it in APAC, and I think US is unfortunately a bit on hold and waiting for some clear guidance there.
As an American, I will have no more comment on that. But I promised one question about AI, so to finish up in the last minutes, looking towards the future, power in the next wave, what will be, or in your opinion, could be, the next ChatGPT moment for institutional adoption of blockchain and cryptocurrencies? I throw it out there.
Okay, well, I start because after it will be very complicated to drop new ideas. So I would say CBDCs.
You think CBDCs are going to be the ChatGPT moment?
Why? Because even for tokenized, it will create instant settlement crypto to crypto instead of doing crypto to fiat. Because at least you need a regulated stablecoin with a legal tender, being probably a government, so that basically people start actually embracing and settle transaction and leverage actually the benefit of the blockchain, because people are not yet doing it, at least in EU or Switzerland. There is no regulated stablecoin. So once you have this,
so you think this is the key?
It will accelerate CBDC combined with, it's a bit a dystopian future, but it's with digital identity. So basically you have this, you have the tools to really have full acceleration of in the space.
Guillaume, what do you think?
I'm not a big fan of the concept of CBDCs. For surveillance purpose. Really not a fan. I think the concept of AI can be applied to regulations. I'm not a big fan of the way regulations are being enforced at this point in time, like all these AML, KYC. What happened with Europe, where they wanted to, at some point, there was discussions around every wallet transaction needs to be KYC'd. I think AI is going to help. There's something that is happening on chain. You see what is happening on chain all the time. It's immutable, and we should be using this technology together with AI to make sure that we can check if the transaction is legit, if it's coming from a proper wallet, if this wallet has been tainted by activity with bad actors, and you can use AI to check all this. So it would be much faster, much better, and I think regulators should embrace that instead of trying to backtrack.
Okay. Any other opinions?
Not related to AI, but one of the ChatGPT moments in crypto could also be if a BlackRock decides to tokenize a large part of whatever they offer and say, okay, this is how you trade it now. And it happens on chain. And sometimes I wonder, I'm post-electronic trading transition, so I don't know the whole history, but I'm like, what triggered the fact that we moved to electronic trading? I think it was more about the venues that imposed that. So I wonder what's going to be okay, you know what? Now we're going to start settling using blockchains because it's so much better. And I'm trying to think what is going to be the trigger for that to happen, because the bottleneck is pretty long, right? As you know, the current infrastructure works. It's slow, it's expensive, it's painful, prone to errors, but it works. And so what is going to be the trigger to make sure that now institutions and issuers and exchanges and everything agrees to say, okay, you know what, let's just do that on chain. And for me, that's going to be the blockchain crypto ChatGPT moment. But so BlackRock tokenizing stuff could be one of them.
That would be quite big. Any other opinions? Lastly, Eva?
I think it depends if we're thinking of the ChatGPT moment as the next big thing. In that case, I think it would be something like Eigenlayer, looking at how you can have restaking via other protocols on top of Ethereum to utilize the security of the Ethereum staking network. Or is it something that results in large both retail and institutional adoption, like we've seen with ChatGPT, where you've got companies looking at how they're going to utilize it and individuals playing around and being excited by it. And I think for that piece, it would be looking at the moment when we have more structured products, for example, ETPs available for institutions to purchase through their ISA, their investment fund. Lots of firms are looking at
securities, tokenized
Strukies. Thinking more crypto here, just like the ETP product. And when that becomes something that I can, look at buying a an ETP via my ISA, where ETH is the underlying, whether I can look at a staking ETP and receive ETH rewards as part of my ISA, and that becomes something that institutions offer, so I can just invest in as part of my other investment strategies.
Final word, Frank?
I think it's also expanding beyond crypto and just go back more to the traditional finance instruments like FX, derivatives, options, and that kind of stuff, and just blend it in with the digital ecosystem. I think that will be the next, from a technology perspective, the next ChatGPT moment.
Super. Thank you all very much. I think we've wrapped it up just about on time. Thank you for listening. Thanks to our panelists. And
how much did you like this panel discussion? Let's show it. Thank you.